I'm curious for your take, first of all, on the real kind of momentum moves you're seeing here and where you stand on the broad market at this moment.
I first have to say that this has been a gut-wrenching emotional market for the last 3 months, but it's the most intellectually challenging market I've ever seen. There are many, many cross currents. You mentioned momentum. I'll mention breadth. The type of momentum we saw off the March lows and the type of breadth we've seen over the last 3 weeks are typical of early bull market action. That would suggest that the market is going to go much higher. On the other hand, we had record volume in the S&P Small Cap Index. We had record volume in NASDAQ, which means that the volume we saw at this high, at this recovery high in the small caps, at the all-time high in the NASDAQ, was greater than the volume we saw at the panic lows in March. This is unheard of. Lows at panic lows last for years. The August to September 2011 volume lasted up until 2020. So I am finding the market's action, rather than being bullish because of the momentum we've seen, is more commodity-like. One of the rules in technical analysis is that stocks never peak on record volume, but commodities always peak on record volume. And now all of a sudden you're seeing the NASDAQ up and on record volume, and now we're declining after a gap. So it looks like stocks have become commoditized. It's probably because of the ETFs and because of the non-sophisticated retail investors that are just chasing up stocks and up indices. So I'd have to say that this market is reminding me a lot of the top we saw in March 2000 in the NASDAQ. In March 2000, you had a gap up, followed by a record volume day that was on March 5th and 6th of 2000, and the ultimate high was on March 10th. And now we've seen three things that are very typical of commodity and some market tops. We saw a very low trend, which is the arms reading on the Bloomberg machine. We saw the fourth lowest trend in 20 years. We saw the highest volume in history. And we saw a ninth one-up day, which means much more upside volume versus downside volume on the day of the top, which was just 2 days ago. And this is consistent with tops we've seen in August of 87, October of 2018, April of 2011, January of 2009, which was a bear market rally, November of 2080, and as I mentioned previously, March 2000. So something is starting to look kind of negative, and we were long until this morning. We went flat this morning. I'm looking to go short if we get some sort of a rally.
Right. So, Milton, that's what I was going to ask. If you almost answered it. You said that you were long until this morning. You've gone flat now. Would one more day of this convince you to sell?
I'd rather sell into somewhat strength. You know, a 1% to 2% intraday rally. You know, selling in the market is an emotional decision, not just an intellectual decision. I went from 150% long last night to flat this morning. It's very difficult to get short immediately. I'd rather not short on further weakness. I'd rather for the market to rally a bit and get people start to believe it again, even just intraday. But yes, theoretically, for a longer term, someone who's not a trader who wants to be positioned, it doesn't matter if you're positioned now or you're positioned tomorrow. If we're headed for a decline below the March lows, you want to be short as close to the highs as possible. Now realize we're only 3 days from the top in the S&P, 3 days from the top in the NASDAQ, in the DAX and small caps. We're only 1 day from the high in the NASDAQ. NASDAQ peaked yesterday, so it's certainly not too late to go short. I'm just speaking as a trader where I'd rather see 1 or 2% rally intraday.
Yeah, Milton, we were talking to folks like Ed Yardeni who are saying, contextually, you have to treat the bear market we've seen here as a panic attack, not a bear market. It was so specific to the economic lockdown, which leads me to wonder what you made of these markets, back on, say, March 15th or even the end of February. Did you think they were toppy then, if we're going back to where we were?
Ed Yardeni's seen a lot of markets, and I've seen a lot of markets, and what we've had is a economic collapse, the most compact economic collapse we've ever seen. But what the Fed did, and with the fiscal policy, is allowing companies that are in trouble to borrow even more money. One of the reasons you get bear markets is companies are over-leveraged, and they can't cover their dividends or they can't cover their capital expenses. Now companies temporarily will have more cash available. That cash is in the form of debt. So this is not a positive for the market. Now, the reality is this market is so unlike any equity market we've seen in history. It's very difficult to have a very broad view. My broad view is that the European markets topped 10 years ago. If you look at the charts, Most U.S. markets topped 2 years ago in 2018, if you look at the charts. The S&P and the NASDAQ peaked in early 2020. The NASDAQ made a new high now. It's a very, very divergent type of a market. I was giving the benefit of the doubt to the bullish side that we had a short recession, we're coming out of it. But the reality is that the way the market acted, the type of speculation we saw into the peak this week is more suggestive of a bear market rally with a major divergence. The only market worldwide that made a new high yesterday was the NASDAQ and the NDX.
Right.
All of the markets worldwide are trailing.
Milton, would you have, maybe a sub-view in there on the FANGs, for example, and the resiliency of the FANGs, or would you also be looking to short those?
The resiliency of the FANGs has really little to do with valuation and fundamentals of the FANGs. FANGs are names that everybody knows Facebook, everyone in America knows Facebook, and everyone in America knows Apple, and everyone in America knows Amazon, and they're buying companies with familiar names that have good product, that act well. But there's no intellectual reason to pay up for these stocks if we're going to have a further recession and further market weakness. In other words, yes, the FANGs are great companies, but they're great stocks to own in a bear market. I highly doubt that will be the case.